Welcome back to part 2 of our series where we are exploring the wonderful realm of order submission, creation, whatever you want to call it, using the TD Ameritrade Python API library. So, previous video, we focused pretty much primarily on what are the operations that you can do with orders. So we know there's many different types of orders out there, but in that video, we were just focused on the operations. And we found out that basically there's 3 main operations. We can create a new order, we can modify an existing order, and we can delete an existing order. So now that we know the basic operations of orders, we are going to move on to order types. Now, I will kind of put this disclosure out there in the sense of there's a lot of ways to write orders, and orders come in many different forms. I don't want you to necessarily watch this video and try to just memorize certain things. I want you to kind of look at it and identify the patterns behind the orders and understand how are we changing the order depending on the type of order that we have, because there are patterns. Now, it's also important to understand that behind the scenes, some assumptions are being made as to, well, what's the duration? And it's assuming that we want it to be canceled at the end of the day, or it's assumed that, you know, we are following certain procedures when it comes to actually submitting that order. So even though these might look a little bit, I would say, simple in a regard, I think there's also certain components about it where it does assume certain things behind the scenes. And we'll discuss that more, obviously, as we start exploring the orders. We will be covering market orders. We will be covering limit orders. We will be covering stop limit orders, and trailing stops. I will talk a tiny bit about trailing stop limit orders. I do not have a working example. I have never been able to get that one to work. I am working on it, and I'm hoping that we can get it. With that being said, let's get started. Okay, so we're going to talk about market orders first. This is probably the most basic type of order out there. Just an FYI, most of the definitions you're seeing right here, these are all coming directly from TD Ameritrade. I thought they did a really good job when it came to defining these order types and just giving us some examples about when you might want to use them and just the little caveats that come along with them. So you can find all this information online. Again, I thought they did a great job, so I said, why reinvent the wheel? Okay, so a market order. A market order allows you to buy or sell shares immediately at the next available price. If you're placing a market order to buy, you'll get filled at the next available ask or selling price, sometimes called the offer. If you're using it to sell or sell short, you'll likely get filled at the next available bid or buying price. Typically, you'd use market orders when you need to get in and out of your positions quickly. 2 takeaways from this: you use market orders when you want to get in and out quickly. So it's all about speed, immediacy, all that kind of fun stuff. The other big caveat with this one is because you are concerned with speed, you might not get the most favorable price. So even though you might say, well, give it to me for $2. Nope, we're going to give it to you at the price. You know, if we're buying in this example, we're going to give it to you at the ask selling price. And so if that's at $255, then guess what? You're going to be paying $255. Generally speaking, they are within a narrow range. However, during very volatile markets, you can have that range that's very large. Or if you're just in a scenario where, again, there's a lot of volume going into it and you just have these extreme moves up and down, then in some cases, you could actually get a very significant larger discrepancy in the price. Okay, so let's walk through some examples. We will not be executing these examples. We will just simply be exploring them and seeing how they compare to other ones. So for a market order, let's use our previous video where we had a limit order. What's different about this one? Well, the first thing that's different about it is we now have a new order type. In this case, instead of being limit, it is a market order. Additionally, in our previous video, we had a field for something called price. That was the limit price. With a market order, you do not specify that price because, again, it's filled at the the ask or the bid, depending on the side that you're taking. So in this situation, there is no point of putting in that price component. Additionally, you will notice down here that our instruction will change depending on whether we are exiting or entering a position and whether we are going long or shorting that particular instrument. So if we are doing a market buy order to enter a position, so we're going long, then our instruction will be buy. If we are defining a market sell order to exit a position, so that means we're closing our long position, guess what? The only thing that changes about this order up here is we now change the instruction from buy to sell. Other than that, it's exactly the same. Additionally, if we are doing a market sell order to enter a position, so that means we are going short, then again, the order is exactly the same. The only thing that changes about it is we are now selling short. Very important that you use sell short if you want to short a position. If we want to exit out of a short position, so using a market buy order to exit a position, well, guess what? The only thing that has changed, again, is the instruction. In this case, we are going to do a buy to cover. So we are going to cover our short position. Other than that, everything is exactly the same. And just as a little recap, session is defining which market session this order is kind of quote unquote valid for. So you either have normal, AM, PM, and seamless. Seamless is everybody. Duration defines how long our order is valid for. Most time it's usually day, but you can do a good till cancel, at which point you just have to give me a date time, and then that will fill in that. And then additionally, because we are doing simple orders at this point, it's just a single strategy type. Now there's OCO and trigger, but that's for the more advanced ones. And then obviously quantity defines number of shares. And then here is our instrument. We need a symbol and we define an asset type. So hopefully very familiar from our previous videos. Okay, let's talk about limit orders. So with a limit order, essentially what we're saying is I want to buy or sell a stock at a specific price or better. You can also use a limit order to initiate or close out a position. So if, for example, you want to enter a position and go long a particular stock, you would use a buy limit order. And so with this one, really what you're saying is if you're looking to buy a share, you want your limit price to be below your prevailing price. And so what this means is if the stock goes down in price, then when it reaches that price, you will then buy that share. So you're using your limit price, it's lower than your current price. And then when it reaches that price, you will then buy a particular share or whatever it is of that particular instrument. So this is entering a position. So the limit price has to be below the market price. If we have a limit price or a buy limit order to exit a position, so exiting a short position, in this case, what would happen is your price would be above your current prevailing price. And so in this case, if you're holding a short position, you can use a buy limit to exit your position at a profit. Or sorry, I misspoke there. It's not above your market price, it's below your market price. And so with this one, your price is below it. And so here you're saying, hey, I'm not going to be greedy anymore. I've made enough profit on this particular trade. I'm going to say, okay, once it goes below a certain price, I've made my profit. And because of that, I'm going to exit my position. So in this case, we're using that buy limit order to exit our short position. So again, just to recap, you want your price below the current market price, because again, when you're shorting it, what you're saying is, hey, I'm expecting that stock to go down. And once it reaches that threshold, you said, hey, you know what? I made my 2 or 3% profit. Get me out. Now we do have a sell limit order to enter a position. And so with this one, you can use a sell limit to enter a position. If you're a short seller looking to sell at a price that is higher than the current price, then you might want to enter a sell limit order. So this may allow you to short a stock as its price undergoes an uptick, moving against your preferred position. Of course, you're hoping that the price declines once your position is in play. So here would be an example of, hey, it's going to go up, 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 right? And then it goes up and you're like, wait a minute, it's too high up there, way too high up there. It's going to go down because it reached that threshold. Maybe it reached that resistance level, right? And you know what? I know if it reaches there, like 9 times out of 10, it goes right back down. So in that situation, you might want to enter a short position because you've reached your resistance level and you expect it to go back down. So in this case, your price would be higher than your particular situation. Additionally, you have a sell limit to exit a position. So this is your take profit scenario when you've gone long. So in this case, your stock has moved up a particular amount, and you know what? You said, that's awesome. I want to get out of this position because I have now basically made enough money. So I'm going to say I've made my 2 or 3% profit. I'm going to take my profit and get out of that position. So what this now looks like from an order structure component, again, look here, what is changing? Well, the only thing we've really changed at this point is the order type, which is now limit instead of market. And we've added this extra field called price. This represents your limit price. Your limit price is when it basically triggers the limit order, and then hopefully it will be filled. So in this situation, your limit price is defined by that price field. It's not the activation price, it's the price. It gets me confused too. I don't know why it's so confusing sometimes doing these orders, but it is what it is. So the price represents the limit price. Again, depending on whether you're exiting or entering a position and whether you're going long or short, that will dictate the instruction. So if I'm buying and I'm going long, so I'm entering a position, it's going to be a buy instruction. If I'm using a buy limit order to exit a position, I would do a buy to cover. Again, the same exact order structure. If I want to use a sell limit order to enter a position, then I would do sell short. And then finally, if I'm going to use a sell limit order to exit a position, I would just do a regular sell order. So in both of these situations, it's very important that you understand that the price will change depending on what type of limit order you're doing. If you're doing a buy limit order, then what is going to be happening is usually the price is below the current market price. In these two situations, your price is above the current market price. In this situation, you're shorting it because you're saying, man, that had a massive run up. It's got to retract, right? So that's why you would do a sell limit to enter. And then finally here, it ran up. I made enough profit. Get me out. So that's your sell limit to exit a position, a long position to be more exact. Okay, so let's move on to the next one, stop orders. So with a stop order, these can be used to in a sense, to protect against certain losses. So the stop order, sometimes called a stop loss order, allows you to enter or exit a position once it reaches a specific price level. Once your activation price is reached, the stop order turns into a market order, filling in at the next available ask price in the case of a buy stop order, or best bid price in the case of a sell stop order. Again, we have 4 scenarios. 2 of them are utilizing a buy stop order. One is entering and one is exiting a position. The entering one is going long. The exit position is going short. So using a buy stop to enter a position, the idea behind here is I look at this one and I say, you are kind of in a sense like, you think it's going to break through maybe, like I would say in the scenario, like, okay, if it breaks through this resistance level, it's got to go up to this next resistant level, right? So it's going to go up to that next degree. So here they have an example. So suppose you buy stock XYZ, suppose stock XYZ is trading at 25, but you want to get long the stock if and only if it gets to 25.50. If you place a buy stop order at 25.50, your order won't be triggered until the stock reaches that price. So I always kind of thought of these ones as kind of like the momentum ones. Like you were thinking, man, like if that stock's moving up like that, maybe it's going to keep going up that direction because, it's just got a nice, good trend with it and it's going to go to its next resistance level. And so you're going like, man, that is awesome. So in that situation, that is when you might want to use a buy stop order. Again, because the stop order turns into a market order, you are not guaranteed a price. And so that's very important to understand. You're not guaranteed that just because you have a stop at 25.50 that when you buy it, it's going to be at 25.50. It might be higher. It might, it actually might even be lower sometimes. So it really just depends. And so in that situation, it normally gets pretty close to it. But if you're in a very volatile market, there might be situations where that price could actually vary quite substantially. We can also use a buy stop order to exit a position. So basically, this is protecting your short position from collecting a large loss. So it's stopping your short position from generating too large of a loss. And the idea behind it is, again, if that stock is moving up in price, you're going, man, maybe the trend's just against me. Get out. Just, cut my losses basically. And so in this situation, you would use a buy stop to exit your position that you've shorted, so that way you can limit your losses. Additionally, you have a sell stop to enter a position, so you can short a particular stock. So in this situation, you can say, hey, in this situation, if the stock is going down, if it's going, if it's going down pretty dramatically, you might say, hey man, it's got a really good downtrend. I want to go in because it just broke its previous support and I think it's going to go to its next support. In that situation, you might want to use a sell stop to enter a short position. So the idea here is, again, you kind of got that momentum trend, if you want to think of it like that, and you think it's going to go down further. Additionally, you have a sell stop to exit a long position. So this is a stock that you bought where you initially thought, hey, it's going to go up, it's going to go up, it's going to look great. In this situation, though, the trend went against you, and instead of going up, it actually went down. And so what you want to do is you want to, stop that loss. You want to kind of hopefully control it to a certain extent. We'll see that this actually doesn't always work, but we can actually do a different type of order that will hopefully contain it a little bit. In this situation, what you can do is you can kind of stop that loss and say, okay, once it goes below that, price threshold level, like get out of that thing. Like it's just not even, it's not in my favor, basically. So how does this order differ from the previous two? Well, in this situation, obviously our order type is going to be changing. In this case, it's now going to be a stop order. And then on top of that, we're now going to change that price field to a stop price field. So in this situation, we're saying, hey, it's going to activate at $10. So at $10, I'm going to buy 1 share of Alcoa because maybe it's on a trend up and I'm thinking it's going to do super well. Now, additionally, we can use a buy stop to exit a short position. So here, we still maintain our stop. We still maintain our activation price, which is really just our stop price. And then additionally, we've changed our instructions to buy to cover. So we're going to stop that loss when we shorted our position. Keep in mind, there is an activation price in the TD Ameritrade API. I have personally not tried it on a buy stop order. I don't know if it would work. I would say you could try it if you want, but personally, the stop price one works fine. And I think that's more intuitive personally, but maybe it's just me. We can also use a sell stop to enter a position. So maybe this is just a stock that's on a horrible downtrend. Well, let's short the baby. Now here, it's still a stop order and we still are maintaining our stop price. However, your instruction has now changed to a sell short. Yes, sell short. Now, additionally, we can define a sell stop order to exit one of our long positions that went against us. So this again will help hopefully stop our losses. Again, stop order type, stop price, and then our instruction in this case would be sell. Okay, so let's talk about our next one, a stop limit order. Take the idea of a stop order and we're going to expand it. So a stop limit order allows you to define a price range, very important word, range for execution, specifying the price at which an order is to be triggered and the limit price at which the order should be executed. It essentially says, I want to buy or sell at price X, but not any higher or lower than price Y. The key here is the price range. With a stop limit order, you risk missing the market altogether. in a fast moving market, it might be impossible to trigger the order at the stop price and then to execute it at the stop limit price or better. So you might not have the protection you sought. So the idea here is you want to stop your loss, but you also don't want to incur a crazy loss. So the way I've kind of thought about it is it's you're trying to limit the extent of your loss. And so you're basically saying, man, if it goes below like $5, like I just cannot incur that type of loss. Like I can't mentally deal with that. And so you would use a stop limit order to say, okay, well, once it reaches there, that activation price, try to fill that limit order, which will then hopefully execute within that range. If it doesn't, then unfortunately, you've missed your opportunity. Again, you really see this in some cases where you have a very fast moving market. It's very volatile and it's just dropping, dropping, dropping. So in those situations, it might not even be filled together. So very important to understand that in some cases, depending on the volatility in the market, it might not even be filled. So in this situation, if I want to define a stop limit order to enter a position, I can say activate at 10, but don't enter, so don't buy above 12. Because once it's above 12, like, you know what, I don't want to get into that thing. I think it's going to go back down. So in this situation, our order type is now going to be a stop limit order. Our stop price, which is our activation price, is going to be at 10. So we're going to say, hey, activate this thing at $10. And then our limit price will be 12. So don't pay above $12. And again, our instruction is still the same. We're going to be buying 1 share of Alcoa. Now, additionally, we can use a buy stop limit order to exit a short position. So in this situation, activate at 10, but don't exit above. Actually, this one's like kind of incorrect. I think I mixed up the notes on this one, but don't cover above 12. So in this situation, it's moved against you, but the market's now moving dramatically up. And so what you're saying is, okay, well, if it moves dramatically up, I cannot incur that type of loss. And so in this situation, don't necessarily fill that order. It could also be another thesis too, which is like, oh man, it just jumped right up. Like it's probably going to go back down, right? That's the idea. So that is a buy stop limit to exit a position. We're now going to go on to the next one, which is a stop limit to a sell stop limit to enter a position. Activate at 10, but don't enter, sell short. And in this case, we want that one to be 9. So this one's again a little bit different. So in this situation, we're saying, hey, once it goes below $10, like that seems like a very attractive price to buy it at. I think it might go a little bit lower, but probably not much lower than that. So maybe it's like $9.50, right? I think it'll go down to $9.50. But again, maybe it's moving down very aggressively, and I don't want to necessarily be in that stock if it's throwing down pretty aggressively because it might retract back up. So in this situation, our stop limit, which is defined here, is going to say activate at 10, but don't buy it if it goes below 9 because it's probably going to retract back up. And in this case, we're selling short. Finally, and I'm sure this one's wrong too, we have a sell stop limit order to exit a position. So in this situation, we will activate at 10, but don't exit or sell below 9. In this situation, I think it was right. Shocking. I feel like I did this one, but maybe I didn't. Oh, maybe it's just me. Yeah, okay. Maybe it was, I don't know why. I feel like I missed something, but maybe I didn't. I hate doing this sometimes because I feel like I switched it off a little bit. But anywho, so with this one, we're exiting a position. So we've taken a long position. The price activated at 10, so that stop price activated at 10, but man, aggressively moving down, goes past 9. You know what? I don't want to deal with that. Maybe I think it's going to go back up. It's moving way too fast down. Or you know what? I just can't incur a loss that big. So in that situation, your limit price will be 9. Your stop price will be 10. And then from here, it's still going to be a sell instruction. Alrighty. And then finally, we're going to talk about trailing stop orders. This one's a little bit confusing, and um, I will talk about the going short version of it, or covering our short position one. I might test it a little bit more because I personally, it's kind of weird to me. I think it might be slightly off, but I have to double check. All right, trailing stops. So trailing stops are not orders per se, but they are means to automatically move or trail stops, basic stop orders, right? And so with this one, think of a trailing stop as a kind of exit plan. So in this situation, we have something that we want to kind of trail some type of price. So here's how it works. In this situation, let's say you purchase shares of stocks and your entire position is now in the profit zone. What might you do with this stop? You can leave it in place and you can move it up to a more break-even level to avoid loss should the market move against you. Or you can set it to trail your profitable position as it moves higher. So suppose you set a trailing stop at a specified distance below your current position. If your position continues to move higher, your trailing stop also moves higher. If your position declines to match the price of your trailing stop, your stop order is triggered, closing your position. In this situation, again, if it's moving up, your stop moves up. If it moves down and it hits that threshold, then it activates and it becomes a stop order. So you're probably thinking, okay, but how far below my position should the trailing stop follow? There are many ways to calculate it. And so you can actually do this in Thinkorswim if you want. But we'll see when we're building our orders, there's actually a lot of different components to it. I'm not going to go into necessarily all the details of them, but I will show you where that information is if you need it. But you can actually link it to certain prices and stuff like that. So the important thing to also remember about a trailing stop is because it's a stop loss order, once it activates, again, you do have that component where it might not get the most optimal price, just an FYI. So especially in very fast moving markets, it can be very messy sometimes. So if we're defining a trailing stop, this is how we're going to build it. First thing is you want to make sure you define a trailing stop order. Additionally, we need to define a basis off of which to determine our offset. Are we going to use the last price? So is it going to be X below the last price, the bid price, the ask price? There's like an average of the bid and the ask. There's a whole bunch of stuff. So I think I have it up. Do I have it up? Let me bring it up. There's a bunch of them. And I think I had a link somewhere too. Orders. Okay, here we go. Orders. Yeah, that's a lot, I know. So your link base is this one right here. So there is a last, a bid, an ask bid, a mark, and an average. I usually see these ones. I personally never seen these ones. I mean, I'm sure there might be a specific reason you would use those ones, but I think for most people, you're probably going to be here or maybe here. And then, so that's our basis. That's what we're calculating our offset compared to. Additionally, with a trailing stop, you can either have a value, so a dollar amount, or a percentage. So if you look here, value or percent, they do have a tick. I've never used the tick, so I don't know if that works 100%. I think in the web interface, I don't even think they give you an option for tick. So it might not be usable. I will try it and then I'll probably just have an example on the library. So in this case, I'm saying use a dollar amount figure as my offset. Additionally, what is my offset? So how big is my value? It's going to be $2. So in this situation, it's really my bid price minus $2. That's kind of the idea behind it. You could do ask, you could do last, whatever you want. The idea here is it's that one minus that one. It's assumed I've gone long. It assumes I've owned the position. Very important. no sense of putting a trailing stop if you don't have, obviously, a position to trail it. So you have to have that position to trail it. Additionally, the stop type. I've always set this to standard. I've personally never done anything outside of that. There's a bid, an ask, a ask, and a mark. See, that's like, to me, that seems like that's confusing. Like, you have it up here, and it's like, you're going to have it here. It's like, which one do you want us to use? My God, man. So I've just kept it to standard. That seems to mimic the ones that I place on the web interface. So that seems to be fine. But for the most part, I would say just stick with standard. I'm going to show you what I think is the covering aspect of a short position. So I don't know if it works. I haven't personally tried it. So here's the thing. I can put a -2 in there and it accepts it. The problem is on the web interface, it changes it back to a +2. Now, I think that's because the position I initially had on wasn't short, so I think that might be the issue. If somebody wants to try that and let me know how that goes, I would be very indebted to you because I don't know if that's necessarily the way I should be doing it for short. I would say yes, because I'm saying, okay, well, no, I guess, yeah, see, that's interesting because it's like here, I would say this should be negative. But I don't put a negative and it seems to work fine. Where this one, that one would be positive. Let's do this. Let's try and see what happens. Do I have my account open? I don't think I do. We'll see in a sec. Is that the one? No, I want order status. Yeah, that's the one. Yeah, I think this was the one where I was doing it on my regular account. Okay, think through this one. I'm going to sell, put it at negative, see what happens. Yeah. Yeah. I think. Yeah, let's see what happens. I mean, see, that's the thing. It took it. That's the problem. It takes it. I don't necessarily know if it's like the way it should be taking it. But see, this is the thing. It seems like even though I put a negative, it still changes it. So I would say it works. I would say that's the way of doing it. I think what the big thing is that this is the important part, is the instruction, because that naturally will dictate the offset, because you can't really use the trailing stop, I guess, to buy in a sense, because that wouldn't make sense either. It's like you're trailing the purchase price, like that doesn't make sense. Like once it reaches the purchase price, like you're going to purchase it. So I guess in a sense, like it makes sense when you think of it like that. So I would say that's probably what you would do with the short one, is you just change the instruction to buy to cover. It still probably is the same. Again, you can still tag it to the bid price, you can tag it to the ask price and all that fun stuff, and you can still do percentages, but I guess it really just depends what you're trying to do at the end of the day. Now, I do have an example of a percentage one. So in this situation, if you want to do a percent, you have to set the price offset as an integer from 1 to 99. 99 being like 99% away from, the bid price, whatever you want to say. So you can use percentages. Keep in mind, though, that those are whole numbers. If you're doing an absolute value, it needs to be a float value. And then with that, that's basically trailing stops. I will talk about the infamous trailing stop limit orders. Never got it to work. But the idea here is it's a stop limit. So instead of having a trailing stop that executes a stop order, a stop loss or a stop market order. In this situation, it's going to execute a stop limit order. And so again, the benefit of this one is now you have that range component. So I can't incur too much of a loss, so make sure it's narrow. that's really the idea behind trailing stop limit orders. I've tried to get this one to work to no avail. I would say, well, trailing stop limit, right? Like nothing crazy. Like I would even imagine it probably should be almost identical to this one because there's nothing there. The only other thing I've thought was maybe have a activation price. I don't know. I feel like I don't know. I've just never gotten that one to work, so I can't tell with 100% certainty what it is for that one. I've looked here. Do I have my little things on here? I thought they had a price link basis because I feel like it would be something related to the price link basis, but it didn't seem to work. So supposedly it's there. If one of you know how to do it, again, I would love to see it because right now I am at a loss as how to do a trailing stop limit using the API. But with that being said, I think I've taken enough of everybody's time. How many minutes was that? Ooh, good Lord, 36. So if you have any questions at this point about just the general structure of orders, by all means, put them down in the comments below and I will do my best to, hopefully walk you through it. Again, depending on the complexity of it, I might not necessarily know the answer, but I can try to at least hopefully pick your brain a little bit and maybe guide you in the right direction. In our next video, we are going to move on to advanced order types. So these are more of the conditional orders, the trigger orders, and the ones that have that more parent-child relationship. So that is in our upcoming video. And then we'll probably talk a little bit more about just some of the finer details. So, like fill or kill, all or none, good till cancel, just things like that. So we'll kind of just briefly talk about that topic, and then we'll move on to the streaming API. So thank you again for watching, everybody. We will see you in the next video.